Alright, ladies and gentlemen, welcome back to the channel. This week is going to be a big one because you get CPI data on Thursday. You also have a lot of Fed speakers, some other data, including the Michigan Consumer Expectation Survey for October, and that is another catalyst that will move the markets in a big way coming on Friday. But most importantly, CPI, and specifically, what does this mean for the rest of 2022? This is going to be a major turning point, either for the good or potentially for the bad. All of it will be discussed here in this video, so let's get straight to it. Do your part. If you feel like it, it's free 99. You already know what I'm going to say. Hit that like button and subscribe to the channel if you guys have not already. And also, if you guys want some free money in 2022, this is the time to solidify your fortunes over the next 5 to 10 years by buying the dip and getting all of these discounts. So, first things first, getting into it with the economic activity that we are going to be seeing over this week. That is going to be the important thing. You also do have some earnings in which we will also talk about. So first things first, starting tomorrow on Monday, you will have Fed Evans that speaks at 9 o'clock in the morning, and then at 1:35 p.m. you will have Fed Brainerd that speaks. These are two voting members of the Fed, so they are a little bit more important. And what we have seen over the past couple of weeks are some Fed speakers, including these two, that are talking about slowing down the pace of rate increases, because if you guys are unaware, it's very easy for the Fed to come out, write a check mark and to raise rates and have the desired effects on economic activity. Well, if the Fed raises rates too aggressive and they go too hard on inflation, they could cause a lot of damage 3, 6, 9, 12 months down the line to the economy, in which they never had to do in the first place, because one, inflation is a lagging indicator, and the Fed raising rates, it doesn't really work its way into the economy for 3, 6, 9, 12 months now. So what we're feeling now is really only the first couple rate hikes from the Fed. Now, on Tuesday, you are going to have a couple smaller data points, but you're, for the most part, going to have more Fed speakers. You have at 11:30 a.m. Fed Harker that speaks. I don't believe he's a voting member, so that won't be as important. But at 12 p.m. you have Fed Mester, which he is a voting member, and that will be important, obviously, for the same reasons. And then on Wednesday, you do have Bank of England speakers, a lot of Great Britain data that does come out. And that will be important because, regardless of what other people will tell you, how the world is doing will affect our markets. If Europe and China and everywhere else was doing terrible, well, odds are we're also going to do terrible. Even if it's not right away, it will be at some point down the line. Nonetheless, on Wednesday at 8:30 in the morning, you have PPI month over month for September. That is expected to be the first major catalyst, major data point that will come out in this upcoming week. And then you have core PPI month over month, core PPI year over year. All of that will be obviously very important. And then at 1:45 p.m. on Wednesday, you have Fed S Bar that speaks. Also not a voting member from my knowledge, so that won't be as important. But then at 2 p.m. you have the FOMC minutes, and that will be big, but these are not usually market moving catalyst, because a lot of it is already what we know, because the FOMC minutes, that's basically a transcript of the last Fed meeting, more detailed conversations, right? A lot of the dialogue that took place, and the markets really care about, the only thing they really care about when it comes to the FOMC minutes is, why did the Fed choose to raise rates what they did? Why didn't they go with 25 basis points, or why didn't they go with a 1% rate hike? The reasoning is most important with the FOMC minutes, but it's all a transcript. It's not going to be necessarily new information or really relevant information. The FOMC minutes are from 30, 45 days ago, so keep that in mind. And then at 6:30 p.m. on Wednesday, you have Fed Bowman that speaks. He is a voting member, so that will be important. And then on Thursday, you have CPI, core inflation rate year over year for September. again, highlighted in red, expected to be a major volatility catalyst, and this will be the biggest catalyst of really the next couple of weeks. Earnings will be important as well, but the course of CPI is important. If CPI does come down in a big way, you are going to spark a cataclysmic, monstrous rally that you want to have exposure to the upside in. That would not be a short-lived rally. That would be probably a multi-week rally if CPI came down in a big way. And then obviously 8:30 in the morning as well, inflation rate year over year. You do also have initial jobless claims that comes out at 8:30 in the morning, and CPI straight up for September. So that's really the big catalyst that will be on Thursday. And then you have China's inflation rate that comes out at 9:30 p.m. The balance of trade for China at 11 p.m. That could also be important because, like I said, the state of the world's economies are important to the American economy, and more specifically to the American stock market. Now, on Friday, you have retail sales month over month for September. A lot of other data points regarding that, but that's expected to be the major volatility catalyst out of the bunch. We'll just call it that. Make sure, pause the video if you guys want to look deeper into it, but that's going to be the big one. And then at 10 o'clock in the morning, Michigan Consumer Sentiment survey, preliminary survey for October. And these are important because, after all, what people expect inflation to be 6, 12, 24 months down the line, that's what usually tends to happen, because people start to say, hey, inflation's expected to be 5%. We're going to get 5% inflation. I need a 5% pay raise. And that is where you get the wage price spiral. There's no signs that that is actually happening now. But again, that can be a lagging indicator if you expect to get a raise in 3, 6, 12 months from now, or if you're a union worker and your contract comes up for negotiations again, you could see how it could be a lagging indicator. Wage price spirals usually don't happen overnight. That's why the markets specifically pay attention to the Michigan Consumer Sentiment Survey, and that's why it is highlighted in red and expected to be a major volatility catalyst. But overall, CPI, the Michigan Consumer Sentiment Survey, and retail sales on Friday, those are going to be the major catalysts. And then, hey, check it out. Again, another big catalyst is going to be bank earnings. And those are really all on Friday. JP Morgan Chase, Friday pre-market. Morgan Stanley, pre-market. Citi, United Health Group, Wells Fargo, US Bancorp, PNC, First Republic Bank. All of those are Friday in pre-market. And hopefully, the banks are doing okay, because if the banks are not doing okay, the markets might freak out about earnings a little bit more. If CPI comes in higher than expected, which, look at the gas pump, look at the price of oil, it's not looking so promising. I'm just going to put that out there. If banks don't do good, then probably companies are not going to do good as well. Thursday pre-market, you have TSMC. That will be big. Delta Airlines, BlackRock, Domino's Pizza. Those are probably going to be the biggest earnings of Thursday. You really don't have anything for Monday, Tuesday, or Wednesday. Besides, on Wednesday, you do have PepsiCo, but it looks like companies are kind of reporting earnings later than not, so that's kind of weird. Usually you have a lot of banks on a Tuesday or a Thursday. Not usually do you have most of the banks reporting on Friday. Usually it doesn't happen like that, so that's something that raises my eyebrow a little bit, but we'll just have to wait and see what those numbers do look like. Nonetheless, as you guys do know, we like to pay attention to the Fed rate monitor tool. So why is the CPI, why are all of these data points so important? It's because we have the next Fed meeting November 2nd, and this is going to be the last CPI report we get before November 2nd. So if CPI comes in much lower and is a very positive beat and is good for the markets, well, the Fed might just pause raising rates, or they might do a smaller rate hike. Because that's going to be the last report we get until November 2nd. And that's why it's going to move the markets so much. At the same time, you're also going to have midterms in November. And historically, markets bottom out in October, like I explained in the video earlier. And then they perform well after midterm. So maybe we get the same thing this time around, and I'll read you guys the same exact quote I put in the last video, just because I think it's relevant for this video as well. It says, stocks have have historically bottomed in October and been positive in the year after every midterm election since 1942. So that means 2023 could possibly set up to be a pretty good year for long equity investors. At the same time, asset managers, hedge funds, computer-driven or human-driven, are at record short levels. And what that means, if you do get a beat to CPI, if things do look a little bit more positive, if you can finally start to see a light at the end of the tunnel, if CPI comes down in a big way, well, that's going to mean a massive short squeeze for the markets. For AMC, for a lot of the stocks you own, probably will go up in a very big way, just because the shorting activity is at its highest level that you've really ever been at. So there's that. And as far as the S&P 500, the estimated short interest of free float is sitting at 19.85%. If we pull up the last 18 months ago, the short interest was at 17.63%. If we pull up 6 months ago, the short interest was at 17.15% back in April. Back in June, we weren't even as high of a short interest as we are now. We were only at 18.5%, almost 19% back in June, when the stock market was actually hitting a low. So usually the time you want to be bullish is when everyone is bearish, and it surely looks like pretty much everyone is bearish as of right now. A 20% short interest on the S&P 500 is absolutely ridiculous. That's categorized as extreme short interest. So there you guys have all of that information. Let's go ahead and pull up the AMC short information as well, just because if you guys want more in-depth coverage on AMC, that's definitely for the video that was put out at 12 p.m. today. At noon, we went over everything you need to know, and I highly recommend you guys check out that video as well, because you're not going to get a lot of repeat information. A lot of that information in that video is for that information, for that video alone. And if you're an ape, if you want to crush the hedge funds, if you're somebody looking for a big trade, a potential big winner, that's your video for you. Now, as far as AMC and the short interest, sitting at 19.25%, free flow out on loan at 36.12%, shares out on loan 186.12 million, days to cover 4.46, cost to borrow 18.44%, and again, 100% share utilization. If we look at the live short interest, the cost to borrow max sitting at 29.22%, the cost to borrow average at 24.51%, and the cost to borrow minimum sitting at 17.13%. So all of these numbers are very, very high and well above where typically they should be for a stock. Let's call it that. Now, as far as the technicals on the S&P 500, you are not quite at the low of 2022 as of right now, but you are surely heading down there in a very fast fashion. We're really just one mediocre down day away from being at the lows of 2022. We're only about 1.58% off of the lows for 2022. And if we go ahead and pull up just exactly how much we are down for the year so far from the peak to where we are right now, guys, you're down 23.75%. So you are down a lot, and things are starting to look a little bit more bullish, but the positioning from the hedge funds very bearish. So that means when things do flip, you're going to see a parabolic rally in the markets with AMC stock. But could things get worse from here? Absolutely. CPI could come in much higher than expected. I think it'll probably come in higher than expected, given what has happened with the price of gasoline over the last month. I mean, gas here in Michigan's getting to $4.50 a gallon again. It was down to $3.20 something a month or two ago. So things are definitely not perfect in the economy. The inflation's not perfect, none of that. But hopefully you could start to see how this situation could really flip on the hedge funds very, very quickly. Also, you do have AMC sitting at almost a low for 2022. All of the oscillators signaling it is severely oversold. And here's my daughter to come ruin the video like always. Say hi. Say hi, Ling.
Hi.
Hi. Say love you.
Why you?
All right. That is going to do it for this video, guys. Hit the like button. Like button. Tell them hit the like button. Tell them hit the like button. All right, she's not going to do that one. But thank you guys for watching. I will see you in the next one.